Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I've got an exciting podcast here today. We're going to talk with two gentlemen from ALM First about their recent announcement and launch of a loan fund investment program under NCUA's pilot program. I've got Travis Goodman and Mark Sun from ALM First. Gentlemen, how you doing today?
Doing great. Thanks for having us.
Thank you.
Very good. And, maybe if you could give a little bit of your background, what it is you do with ALM First, and then we'll just kind of dive into this exciting news that you announced this week or last week.
Sure, I'll jump in first. This is Travis Goodman. Been with ALM First since 2003, so just past my 23-year mark with the firm. And over that time frame, I've worked with a lot of different groups within our company, but more specifically as our advisory services group, which handles our client relationships, and then also work with our loan trading group, which is where this loan fund ultimately sits within the firm. So we've been very active over the last, I would say, almost 10 years or so in terms of trying to pair up and match buyers and sellers for loan participations, which kind of a matchmaking service, if you will. We've been working with third-party origination channels. We do securitization advisory work for credit unions that are trying to come to market with large-scale transactions. And the loan fund that we're going to talk about today was kind of a natural extension of that as we've been evolving some of these services. So I've worked with all of those things over the last 5 or 6 years or so.
Very good. And Mark?
Uh, Mark Sum, I'm kind of the newbie, so he's been 20 plus years. I was brought on board, very exciting about this new opportunity of creating a new loan fund on behalf of a credit union. So the concept itself is extremely exciting. So my background has been predominantly in the institutional side. So I've been on the buy side, sell side with money center banks doing securitization product, as well as about 4 years worth of portfolio management in QSIP style investing for a small fund, roughly 300 plus million. And Travis saw the need for a portfolio manager with some of my experience going through several economic downturn. So I said, sounds like an interesting challenge. So here I am, very excited to be able to bring his concept in mind into a reality. So that's why we're here to talk about it.
Very good. And before we started up, we were chatting a little bit about the intensity of getting to the finish line and getting a product launched, and it reminded me of the NCUA NGN program and the road shows that needed to be done to go out and try and sell the product, right? Because if you're going to launch it, you want to have buyers, right? So I'm envisioning that might have been a little bit of what you guys were going through recently. And I saw in the press release that you had a call with potential buyers, I think, in the last few days. But so, hey, explain what it is, how it works from the 10,000 or 5,000 foot level, and then maybe we can dive into some of the specifics.
Sure. Yeah. I think your analogy is pretty accurate in terms of, the NGN notes back in, was that like 09 maybe or 10,
Yes.
something like that.
Yeah.
So I remember those coming out. Those were it's probably, again, very similar. I've told Mark a lot in this because, we've done some new innovative things at ALM First over the last 10 or 15 years. And every time it feels different than a process that is well structured and figured out. And you know exactly when you're going to go left and when you're going to go right because the map's already been set. Whenever you do something for the first time for an industry and for your company and for everything else, there's a lot of questions that have to be answered as you go along the way. So, that's what's been really fun and exciting for us. The loan fund itself, if I would just want to give kind of an overview of what it is, it's a completely new way for credit unions to buy assets that has never been permissible prior to December of 2024 when NCUA approved the pilot program. And what it essentially does is it allows credit unions to come together with collective purchasing power under a fund structure to go buy whole loan assets from other entities, primarily through credit unions. So the loans that we purchase have to be memberized, so we have to stay within our industry. But there's all kinds of really amazing and unique things that this new structure allows the investors and for sellers to come together to do. But essentially, it's that kind of pooling of assets and the collective purchasing power of that pooled benefit.
Well, and so, when I hear that and I think about a typical loan participation, right? If I credit union that has excess capacity for members who want loans, and I find other credit unions I can sell to that there's a certain particular process with that, and then there's loan participation contracts with that. And I'm guessing that the way this product works, there's some advantages, and it works different than loan participations, and it might have some different bells and whistles, or it might have some different limitations relative to that. Could you come in, kind of maybe walk through
Yeah.
how? So if someone calls you and says, "Hey, I'm doing loan participations. Why would I want to do this instead?"
Yeah, that's a great question. I think, maybe another way to think about that is to compare kind of all the different buying opportunities that credit unions currently have and kind of where this fits into that. Because when you look at participations, which is predominantly how credit unions buy and sell assets today, to your point, it's a bespoke transaction between two parties. There's a legal discussion that's going on between the two of them. And, there's all kinds of individualized negotiations that are happening at kind of at that level. Typically, the transactions are smaller in size. They $5 to $50 million. Sometimes they get bigger than that for the very largest transactions, but for the most part, they're probably in that $10 to $15 million range. And a transaction is a lot of work, right? There's a lot of things that have to get done to make sure that you've done all your due diligence and you've priced it correctly and all of those pieces. And when you start doing it for small sizes, it can be challenging. When you think about on the seller side of that, certainly someone who's selling a lot, let's say they're selling, $300 million a year, and they're doing $10, $30 million transactions a year. That's a tremendous amount of legal review, pricing, negotiations that are kind of always happening that become really difficult to do kind of at scale. So what ends up happening in those cases, as you start doing more and more trades, is you start thinking about what other markets can I go to? And so institutions from our clients, as an example, that wanted to do that, started going to the securitization market. And that's a place where you go and you can sell $300 million in one transaction. There's a standardized legal document. There's a defined due diligence process that's done by third parties. You may have S&P or Moody's that come in and do a loss estimate. You're going to have KPMG or somebody like that come in and do what's called agreed upon procedures, which is a due diligence document. And then you're going to install a payer agent that kind of collects all the money on behalf of them. And that helps serve that kind of scalable benefit. The loan fund kind of sits in between those two things, where it wants to have the same process that securitization has. So it has a loss estimate that's coming from a third party, from like S&P in this case, our first one. And then we have our due diligence document coming from, again, a reputable third party. In this case, it was KPMG. And then, after that, we have to have a cash management process because we don't want it all coming to ALM First. We want it to be in a secure kind of third party place. And so Wilmington Trust comes in and acts as that third party for us to collect all the payments. So when you kind of go back to the original question of why would a buyer want to come into this? Well, they get to come in and buy in a similar fashion that you would in a capital markets transaction, a very securitization-like transaction, but you get to share the resources and benefit with other investors in a large-scale purchase. So that helps the buyer side. The seller side gets the same benefit if you think about it, because now they don't have to deal with 30 different institutions that are constantly coming to them with different bespoke legal reviews, arguing over pricing, arguing over credit. There's a more defined process that makes it easier for both the seller and the buyer. So that's kind of, I think, one of those other pieces. And then if you think about any other transaction where you have 10 buyers coming together and say, we want to go buy this one product, and I can give you an example of kind of what helped us lead to this loan fund to begin with, but you get more purchasing power by coming in together as one versus individually going to that seller and saying, let me buy it out, right? So that's the other benefit from an investor who wants to become a little more sophisticated. They either want some more due diligence, they want some more third-party benefit of loss estimates that help kind of moving from a participation transaction into a loan fund, if you will, transaction.
Yeah, and as you kind of described that, I've seen some challenges from loan participation side, kind of where you're describing. You have a lot of credit unions buying from you, and and the first three that you do, you have one standard contract, and then the next one comes in and they want to tweak this, and the next one wants to come in and tweak this, and then you've got your 6-7 years out on your duration there of having done all these participations, and then you've got to track those 7, 8, 9 different versions of that loan participation agreement and make sure that as lead lender, if something happens here, that you're looking at the right one where you change the rule in that way. There's maybe a little bit more standardization here than that scenario, and you alleviate a little bit of that pressure from the originator. Does that make sense?
Yeah, definitely. We're trying to standardize all of those processes so that they're very consistent and uniform. I think if you take that even further, where you were thinking about, let's go back to the 21 and 22 timeframes when everybody's working with, these FinTech operators, and that's the kind of buzzword of the day, and everybody's trying to look at these different solutions. I come in and work with one of those parties, but I'm the last one to join. There's been 20 other credit unions before me. Well, the credit union that was 20 before me, they get a much better price because they came in earlier, right? Now I'm the last one coming in. I'm not getting the same price. And so you don't get that benefit of being the early adopter. You're actually the late adopter, and it's reflective in your return as a result of it. Whereas, structure like this can say, look, we're all getting the same thing because we're coming in together. And therefore, we're going to have standardized documents. We're going to have standardized pricing. We're going to have standardized underwriting procedures. And because you're only dealing with the one party here coming into it, it doesn't matter that there's 30 people behind it or 50 people behind it, because it's all being viewed by the seller as the one channel coming in. And that creates all kind of operational efficiencies for the seller and for the investors, whether it's legal, pricing, credit, you name it.
And that's interesting. And then if I understood this right, correct me if I say anything that's wrong, the first fund there's a limit of 30 participating buyers that have to be complex, meaning over 500 million. Did I get that right?
Yeah, this is probably one of our most challenging aspects of this process, and when everybody kind of like comes back to you. We are actually only allowed to work with 30 ever. Not in the first fund and not per fund, which would be way easier, but we're only ever allowed to work with 30 total. So that means that the investors have to be willing to kind of work with us in terms of being able to look at multiple strategies. We have to be able to, deal with certain size and investing benefits. We are allowed to have up to $10 billion outstanding at any one point in time. And that's a pretty decent amount of money, right? It's not insignificant by any means. But if we only have 30 institutions that can work with it, that's pretty interesting, right? That changes kind of how it works. And beyond that, we are allowed to work with state chartered credit unions as well, but they have to have federal parity with NCUA regulations. So that doesn't count against our 30. So that's kind of how we can broaden the universe
Oh,
beyond
that's
just the
interesting.
30 itself. But we're only allowed to work with 30. But that $10 billion cap does not determine, it doesn't matter how many people are involved in it. We still, whether we have 30 federal and another 30 state, we still can't go above the 10 billion. So that's something that we are always mindful as well as we think about who can come invest with us.
And thinking out loud, I saw a reference to a 5-year window and a 7-year window. I think the longer might have been from approval. What is it? It's the earlier of one of the. If you can maybe kind of walk through.
Yeah, we'll give you the update there. So we, from the time that we were approved, and maybe just going back a little bit in terms of this process took about 3 years for us to get approval with. There was a couple of, large market dynamics occurring, if you kind of remember, between Silicon Valley Bank and some of those other things that, I think helped maybe distract NCUA a little bit from our little pilot program here. But that's certainly reasonable and justifiable. But we started at the application in 2021, in addition to some of the things we already talked about, because we felt like credit unions needed a way to be able to pull the money, have a disciplined asset pricing approach. We saw a lot of transactions that were occurring where trades were happening without kind of good pricing methodologies behind it. And we saw some opportunities to work with third parties that would be beneficial for credit unions to work with. And so we submitted the application in 2021. And we didn't get approval until December 2024. As part of that, though, they said, well, how long should this last? And we said, well, let's talk about that. And they said, well, we think that we'll give you 7 years from when the product was approved, which is December 2024, or 5 years from your first trade. If you don't get a trade done for a couple of years, this thing will expire no matter what. And that way, that will be the first litmus test. And the second one is if you get a trade done, which we did last week, that will start the clock for now 5 years for us to evaluate whether or not this is truly a better way for us to buy assets. And that gives them that window to evaluate our process. They get to come in and take a look at the investors that are in the book. They get to look at our books and processes and due diligence. They get to do a joint exam with the SEC when they come in. It allows for that kind of to occur and for them to evaluate whether or not this makes sense for credit unions to have on a more permanent basis after the 5 years is up.
Yeah, and I'm glad you brought that up because before we hit record, you and I chatted a little bit about the derivatives pilot program from 25 years ago, probably 23 years ago, which ultimately led into some authorities being granted by NCUA because they were comfortable with how pilot programs were working. And that's why if someone's listening to this and saying, "Wow, I'm 490 million, so I'm not complex, uh, and I can't be one of those 30 credit unions that participating," that doesn't mean at the end of this pilot that maybe NCUA tweaks some regulations to the extent that that's what it would take to offer this on a broader scale. There's still that option down the road. Am I interpreting that right?
Yeah, I think so. And if we do our job correctly, this will hopefully become a more permanent program for NCUA to be able to offer to credit unions, which I think will be tremendous for them to be able to go buy assets in pooled format, especially for smaller credit unions. If you think about it, like those are the ones that could really benefit from pooling assets together. So that would be really advantageous for them. I do think, while we can't put you in the fund if you're, below that threshold, if you reach out to us, we may have some other solutions that might help you that could piggyback along certain aspects of this. So, I wouldn't say that the benefits are completely off, for those credit unions. But yes, we can't have you in the funds, but we may have something else that can be, similar to that.
Got it. And then you kind of walk through the independent side of it and the loss determination. We've talked more about the investor, but so let's talk a little bit about the loans that would go into it. I think I saw somewhere they're consumer under 10-year maturity.
Yeah, and maybe Mark, if you want to talk about kind of the underwriting process and the vendors we worked with, but I'll just give you the guardrails. We're allowed to work with any asset that has a maturity date and an amortization schedule that's less than 10 years. So I think NCUA's thought process there was they didn't want something in a pilot program that ends 5 years from now. Let's say that, they decided not to continue with it. They don't want something sitting out there for 30 years or 25 more years because there was a bunch of 30-year mortgages that got purchased. So they wanted to kind of keep it at least initially to short, term assets. So maybe that'll be something that changes when they hopefully kind of make the program more permanent. But maybe to talk about some of the pieces of like when we buy assets and the third parties we're working with, Mark, do you want to describe a little bit kind of what we did there?
Yeah, everything basically starts pretty much in terms of how you evaluate credit is looking at the different aspect, the consumer product, auto being the primary. So everybody has pretty much a large percentage of the investment in the auto. So it wasn't as difficult, but the process that have to go through is you want to at least benchmark what you see versus what you see an individual credit union has been producing the product. So that means static pool information and looking at losses over time, particularly through crises. Those are the one that tells you how well from the collection as well as risk adjustment that the company has made. And everybody points to the 22, 23 as the oh my God era. And that certainly we are seeing a level of stabilization, but we are stabilizing at a higher value than what we saw pre-COVID crisis. So why I said that is because if you look at the affordability as well as the loan balances, they are a lot higher than previously. So that's a challenge for us as we go through that process with rating agency. Why we need a rating agency is because rating agency sees so many institutional deal that come across is for us to have a third party valuation is if we show you this particular portfolio, how they underwrite, what do you think the expected loss would be? And we take that in and we work with the seller in here. And the way we work with seller is we want to produce a buy box as incrementally for a efficiency on their end, as well as from a risk perspective that we can assess. That means when we have to develop that static pool loss information to the third party to evaluate, we're very much focused in terms of what we're buying, not a complete, hey, here's the book. When you guys take a look and tell us what it is, we want to be very focused in terms of what we buy. So that's about a 3 weeks process, and it's a very extensive operational review. So if you have gone through securitization, one of the benefit is the operation review is more of an update, but it allows us as a portfolio manager to listen to the differences that they have progressed through the time they did a securitization to now. So for us, it's more of an update and allow us to follow the progression of the way they underwrite, the way they collect, the way how the portfolio has been performed over that period while they do securitization after securitization. So that's the framework for which to which we look at losses. On the operational side of the equation, where AUP comes in, which is agreed upon procedure, and that's when you start underwriting the collateral itself. So that's mean we'll take samples of those loans that we anticipate to purchase, and that give us a sample in terms of how those loans are matching to the way the underwriting process is done. We go a little bit step further than a traditional securitization AUPA, in the sense that we also do an audit on the vintage. When I say vintage, is basically following through certain loan through their collection process, making sure they are managed as well as conforming to their own collection policy. That includes skip a pay, that includes extension, and what have you. That way, we know that they're doing their collection as described in their manual. Since all of our loans, our preference is having servicer retain the seller retain the servicing. So that in itself is what delivered the performance back to us. So we want to make sure that they're following their own steps in terms of how they collect, and also more importantly is defaults, is how you progress through the default, and that is something that we also tested to make sure that it's follow the right collection in terms of how you repo, if you call repossession timing. And there's certain timing we want to make sure that it's following their own process, and that we can see from the performance that are they typically 45 days out or are they 60 days out. From a cash flow perspective, that is important in terms of how we look at recovery value coming back into the system. And that's how we, as a encompassing everything, and that give us a overall view what we should be paying for collateral, how we should be valuing this collateral that we want to buy on behalf of the credit union.
Got it. And yeah, I might be oversimplifying this, but so someone gets into the fund and there's cash flow monthly on the loan portfolio. They get cash in on the program. I'm presuming monthly. Someone, there's X number of charge-offs at a loss of Y, but there was also yield of a bigger number. Is that netted during netted in the, and then at the end at the takeout, right? When when it all comes to maturity later, that would kind of be the great equalizing moment as the loans have all matured and then the cash is just paid out, or that might be over.
Yeah, that's exactly right. So basically what happens is, on a month-to-month basis, the sellers are remitting payment to our collection agent, essentially.
Yeah.
From there, expenses are removed from the fund structure, and then everything that's left over is remitted back to the investors on a pro rata basis. They're getting a full, principal and interest cash flow. Now, as charge-offs and things like that are coming in, it's obviously reducing the overall cash position, but this is not a structured fund, if you will. There's no priority of cash flows that are pushing up or down. It's just coming back to the investor based on their ownership percentage of how they invest coming in.
So there's no super tranches and these guys get paid first. It's everybody's an equal buyer.
That's right.
Yeah.
That's right. Yeah.
That makes sense. And then the credit unions that are putting loans into the program, how are you looking for people on that side of the equation, or is that side already lined up, or how does that work?
Yeah. We have a couple of entities that we are currently working with, and every loan that we purchase has to come through a credit union. So, the first purchase was through a single entity credit union, and they sold us a pool of assets. We are working with other people to bring on more, but, we can also look at, for example, a third party that wants to sell into credit unions. And let's say that we like the attractiveness of the product, but they have no existing way to get into the credit union industry, if you will. Then we have a credit union that we put on the front end of the front end of the process. They memorize and essentially kind of bring the loans into the credit union system.
Sure.
And then that credit union then turns around and sells it to the loan fund. And that allows us to work with FinTech partners or third-party origination channels. And I think that's kind of the second phase or third phase of where some really value comes here, where we can then work with entities that would normally not work with any one credit union because there's not enough purchasing power from that one party. But the fund itself has a much greater amount of purchasing power, and therefore gives the collective benefit to its investors through those channels.
Yeah, I just want to add a little bit to the investor base. Having 20 plus years dealing on the institutional side, when the when the top proposed that, hey, won't you come in and help us with the credit union? To me, it was like we never heard credit union having the ability to invest in product like this. So when we did our initial outreach to some of third party, they realized that the funding that's coming from it's very different than what you typically would see in the institutional funded private credit. Because what typically happened there is everybody have a different investment threshold. So the portfolio manager is always tasked like which dollar do I need to invest first to get the best return for my investor. In a credit union setting, one of the things that I realize, again, I'm a newbie in the credit union space, is how steady and stable the funding dollar is. Meaning, if there is a decline in the economic scenario, you actually see the deposit rate goes up. That is something a lot of folks out in the institutional side do not recognize. So I think credit union actually have advantage because we are actually providing an incremental amount of funding into the system that is not as volatile as you will in a traditional private equity or private credit fund.
Interesting.
And
Yeah.
secondly,
Go ahead.
yeah, secondly, for credit union investor coming in, because now you have a marketing, not marketing, but a avenue for third parties such as any OEM, any financial independent finance companies, or even fintech companies, as we talked about quite a bit. They also recognize that this is a separate pool of fund that's available, and they're more willing to start working on the one central point, just because we're bringing more of the institutional way of looking at this. If I was an institutional buyer today, I like to know that there is standard process and policy that's in place that I could easily identify. Rating agency, I could easily identify. AUP process, I could easily identify. That takes a lot of that mystery, if you will, from the third parties. Like, well, you guys are credit union. How are you guys looking at this? We're standing in between, showing them, look, we're following exactly how you guys do securitization. But our process is to make sure that we bring that knowledge base in and then disseminate into our investor, which are credit union that you guys had never seen before, other than maybe individual discussion that you have. Maybe then kind of have, we can't keep doing this 10 million, 5 million, or
Right.
$100,000 loan. Here's a way for us to create a big scale at the same time, protecting the credit union investor that's coming in.
No,
Yeah, it's
that-
something very interesting in the marketplace that, again, 20 plus years in the institutional side, when Travis asked me to join, I go, credit union, are you freaking kidding me? Really? So when he showed me the number, I go, what? Really? So even someone like me has been in the profession this many years. I never really took a look at sort of what the credit union can really bring to the table.
Sure.
And this is something that we did pitch to a few, even OEM. They thought that this was a very interesting product because we are bringing capital in without asking for leverage. That's one of the thing about the fund is we're truly a cash increment to the capital market today. For a lot of folks that are doing ABS securitization or whole loan, if you know a lot of the whole loan that's being created today, it's almost like I would love to buy a whole loan, but you guys got to give me leverage at the same time. Because this is traditional private credit is I need to make sure that I make the most money. And that what we're coming in is I'm willing to buy your product. I don't need leverage. So I'm not going to compete against your own capital market banks that providing leverage today because we're truly are incrementally adding additional cash value to your program.
Yeah, that's exciting. It's the credit union difference, I guess, is what you're experiencing here.
Yeah, it's been really fun to see Mark, his eyes kind of illuminate about working in this industry and all the really great benefits of doing so. So, and Mark touched on a really great one, which was that like funding benefit that most credit unions don't really, I think, really quantify well enough. Because when you look at credit unions that are highly retail deposit based, they're usually below the excess capital, at least the $250,000 threshold for uninsured limit. That means that depositors, especially in times that are tough, is trying to save money. They're putting money, like they're kind of hoarding back away that cash, and that brings cash to the credit union system where they're getting excess liquidity when everybody else is needing it. And that creates an amazing opportunity to provide liquidity to people who want it at a better return. And we used to always say, we talk about this to our clients all the time. I want to give my liquidity when the market needs it, so I can get paid for it. And then when the markets have excess liquidity, I'm going to pull it back. And that's a great way that we can think about kind of the benefit of this fund being able to do so as markets are fluctuating around.
Sure. No, that makes a lot of sense. Looking at the notes here from the release and/or the NCUA website, let's see. It looks like there's a 50% limit on net worth for all of the funds and a 15% net worth for any single fund. Do I have that right?
Yeah, and what NCUA did that I think makes things pretty simple for the investors to come in and take a look at is that they said that no one fund, first of all, they're going to be closed end. So they're open for a window and then they close. And so the first two fund windows are 6 months, and that allows them to go, okay, we read the closes, no new money can go in there. It just goes back to the investors. Fund 2 opens up after 6 months and it's open for another 6 months. After that total 12-month window, it closes as well. And they said that in aggregate, as you invest in all of these funds, because they're just going to be kind of terminating and then, reinvesting cash flow into new ones, you can't have more than 50% of your net worth in all of them. And you can't put more than 15% in any one fund. And so that just kind of helps distribute from a concentration risk perspective.
Sure.
But because of the closed end nature of this, and they open, essentially every 3 months after the first year, we really hard to invest 15% of your net worth into one fund, but that also helps with tracking performance. So we now get to look at individual funds historically and say, fund 1 has this return, fund 2 has this return, and we're not adding new dollars into that. So it doesn't make the tracking of performance of fund, over time, very muddy, if you will.
Sure. That makes sense. Well, gentlemen, this has been a lot of fun. Is there anything that I didn't ask you that you'd like to highlight as it relates to this exciting new opportunity?
Mark, anything you want to add before I jump in?
Besides, trust us. Other than that, it's an exciting opportunity. I want to just to make sure that the credit union that participate in the fund, as well as that are looking to sell, this is something that's very, very unique in the marketplace. I'm certainly excited to be part of the team. I think as we continue to build success on that, I think folks going to realize that this is truly a wholesale level. I'll bring a lot of benefit to both sides, both seller and buyer.
Very good.
What I would maybe add is that I would think that whenever you do something new or different like this, there's obviously a lot of questions that come up from everyone because they're understanding how does this work? How am I protected? What is the real risk associated with these transactions and things like that? And so, certainly from a risk perspective, you're buying whole loans. So we want to make sure that you understand that you're just like buying a participation, like there's credit risk in that transaction. And there's credit risk in this transaction as well. But one thing that I think Mark and I have tried to do really well is to understand that, not everyone understands all of this stuff right away. A fund structure is not common in credit union land. So if you have questions, please ask us. We're happy to walk through all of these pieces. And there's all of our investors that have, participated with us. And these are some very large investors that are $10+ billion in assets. They've had tons of questions, and it's okay to do that. So we've spent hours on the phone going through all these little scenarios of how we're going to do stuff and what we're going to do and what the process looks like and how does this reflect in the legal documents. I think that's more than fair from anyone who's considering something like this. So if you have questions, feel free just to ask and we'll talk through it. And there's no shortage of, or no maximum limit as to how long we want to do this, because we know when we do something new that there's some, questions that have to get answered. So we're happy to do so.
And that's a perfect segue so if someone has listened to this or watched it and they're going, hey, I'm really excited about possibly talking to you guys about participating, what's the best way for them to reach you?
I would say we have an email address. It's loanfund@almfirst.com that goes to Mark and I. That's an easy place to go and probably the most direct place. But if you go to our www.almfirst.com as well, there's a bunch of links related to the loan fund additionally there. So you can go to either avenue, but loan fund at ALM First is probably the easiest.
Perfect. And I'll put that in the show notes.
Great.
Very good, guys. This has been a lot of fun. I want to thank you for your time and talking about this exciting new opportunity for credit unions.
Absolutely. Thanks for having us, Mark.
And listeners, watchers, I want to thank you for listening or watching, whichever you're doing. I hope you'll do that again soon. This is Mark Treichel signing off with flying colors.